It's a pleasure to be back with you with the latest episode of Investors Hangout, brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Today's topic, should you invest in gold? And to discuss this topic and to answer all the queries that you people have sent us, I have with me the CEO of Value Research, Dhirendra Kumar. Dhirendra, a warm welcome.
Thank you.
They say all that glitters is not always gold, but this gold seems to be glittering quite a bit. What could be the reason? Just out of curiosity, I want to know, what are the reasons behind such high yields that one is getting in the gold over the last 1 year?
It's not actually exactly 1 year. Last 3-4 months it has really zoomed, and gold makes a periodic comeback and a big comeback periodically. But don't lose the perspective. Look at 3-year return, 5.6%. 5-year return, 6%. 10-year return, which also encompasses one of the biggest gold boom that we have seen in 2009. It incorporates that 2009 to 2019 is also 8.5%. So gold is an investment. People have a traditional view that this is something which is bankable, king of bad times. And whenever there is greater uncertainty in the market, gold zooms. But as an investment, I have my reservations, I have my apprehensions. These 10-year returns of late, and these 10-year returns also incorporates or takes into account some of the big, jump we have seen in prices, including this 25% in the last 3 months. So gold is something to be had. I think, my view is that feel happy about the jewelry you have, feel happy about showing it off to people. It's an asset of an extreme bad time, but in a modern economic framework, it has limited role. Indian savers still are hostage to, India and China both, are hostage to the traditional view of gold, that it's an investment of bad times, it comes in handy. And it did in olden times. If Indian partition in 1947, people in Pakistan, the difference was people who had gold and people who had other assets. Somebody who can carry the gold was well off, he was not. So in that sense, but those times are gone. I think, you need to really look at all the kind of things, the kind of uncertainty that we have seen in recent times, US-China trade war, all the global uncertainty, some apprehensions about oil supplies, that led to a little bit of turmoil in the financial markets. Gold went up. It goes up and goes down in bad times, or in very extremely uncertain times, and that's about it. It does not translate into something meaningful. It's also important to understand the character of gold. When you buy any asset, when you buy equity, you become an owner. You are entitled to all the benefits, all the cash flows, you become the owner, and it reflects in the stock market, stock prices. Sometimes it does not over a period of time. If earning keeps growing, it reflects. When you are lender to somebody, whether you are a lender to the government, whether you are buying the post office scheme, or whether you are buying a bond, or whether you are buying a bond fund, you are entitled to the cash flows and repayment of principal on time. Depending on the credit quality, depending on the quality of the borrower, you get high return or you get low return. So there is a reason to it. When you buy a home, you are able to save on rent, or you are able to rent it out. So there is a cash flow to that asset, and then depending on the location and other things, other variables, demand, supply, price goes up over time. Maybe not. But that's the hypothesis. There is an asset and there is a economic premise to it. This gold thing just sits there. It doesn't work. And if you have too much of it, you'll have to spend money to make sure that you still have it. So that's saying, it's not a productive asset. The appreciation entirely depends on other people still being excited about gold.
Okay.
And you have to bank on that to be an investor in gold.
Okay. I have two related questions to the conversation that we are having. One is that the uncertainties don't always last. So that means the glitter is not going to last. That's what I gather from you. And the other thing is, don't buy it as an investment.
Yes.
Is what you are saying. But then what do? Should one in any case invest in gold or not?
No.
How about psychologically, giving us that, assurance that I have
there is a reason for it, there is a reason for it because, look at the society, the Indian society. Boys used to inherit the assets, girls used to be married, used to get married off. And if you gave gold, that used to be the, what in Hindi, in traditional terms is called Sridhan. That is something which remains her property. So in that sense, that's a traditional view. It has the oldest repository. It's the oldest repository of value. The modern economic system, the currency, everything is 100, 150, 200 year old. This thing is 2,000 year old, or maybe 5,000 year old.
So it's difficult to get it out of your system.
Get it out of your psyche. Easy to carry.
Yeah.
Small volume. If assuming you have to carry something worth 50 lakh rupees, and if you have to carry a gold bar, it's easy to carry one. Good, realizable. It has, in fact, and the financialization of gold that has happened in the last 10 years. You have gold ETFs. Now you have Manapuram finance, this finance. You need money, you have gold, get it quickly. So in that sense, it acts as a good collateral. People think it's valuable, but it's actually, you have to look at any investment in terms of risk, return, and liquidity. Risk may be low, return not meaningful, and liquidity reasonably low. It has gotten liquefied of late. So purely in terms of risk, if it is low, return, and then risk gets lower only if you are holding it for a couple of years. Might as well hold something more productive.
Yeah. So consider it only as a consumption.
Only as a consumption. Feel happy about it, and maybe some reserve emergency, extreme emergency allocation. That's about it.
Okay. So, but what part of it of our portfolio should this comprise?
Zero.
Ideally.
Think of it as, it's not part of your portfolio.
You're going to break many people's heart when you say
no,
zero.
Enjoy the jewelry. Buy it. Change it every couple of years, because, the cost of owning it in terms of making charges, you buy 1 lakh rupees worth of gold jewelry and you want to get rid of it. Get a sense of what you'll realize. That is also the time when you'll realize that how impure or pure it is. That apart, now there are different forms in which you can have gold. And jewelry is one of the biggest form in which it is being sold. It's not the gold coins, gold bars, gold ETFs. Though they have not really taken off, because understandably, there's a process to it. There's a fun to it. You go to a jeweler, choose the design, do this, do that. There's the whole method to it, and you enjoy it. So look at it as fun. Look at it as an activity. Look at it as a consumption. And I haven't come across too many not so well off people getting rid of their jewelry in bad times even.
Okay. So what are the different ways in which we can buy gold?
Yeah,
if you would like to.
If you are still a gold fanatic and you are committed, there are multiple ways of owning gold. And in India, we are very lucky to have, one unique avenue which is not available to any investor elsewhere. Of course, one is gold ETF. So you buy a fund, go to your open a brokerage account, choose the gold ETF, and gold ETF is available at today's market price of gold in certain units of 1 gram and 10 gram.
You need a demat.
You need a demat account. So you are able to buy it, and the price of these gold ETFs move in tandem with the gold prices, less annual expenses. The cost of running the gold ETF is reduced from that. But that's a very complex thing, opening a brokerage account, doing a trade and all that.
No SIPs here.
No SIPs here. So there are funds which are, to make it more convenient, there are funds which are created where you put the money and that money gets invested in the gold ETF by the fund company. So it's an overlay. It is an envelope in which the gold ETF resides. And the only investment of these funds is gold, buying physical gold which is kept in a locker and valued every day. Then, an interesting option that has come about is sovereign gold bonds. These are very interesting. It is guaranteed by Government of India, issued by Government of India. So you buy these gold bonds. They have 8-year investment time frame. They keep getting, they are issued every now and then. Every 3-4 months we come across the issue of this. And they get you the gold price. If you buy today, whatever be the gold price, and 8 years from now, whatever be the gold price, you'll be able to get the difference plus your capital back. On top of it, you get 2.5% extra return. So all other avenue of gold, you get little less than gold prices. Assuming you have a gold bar and you are lucky to actually sell it at its price whenever you want to. But then there will be a cost of it. There will be some deduction in terms of transaction cost, or gold jewelry making charges and other things, can reduce it by up to 20%. Gold ETFs, they have 0.5%. Gold funds which invest in those gold ETFs could be 1.5%. Here is something which is gold prices plus 2.5% and Government of India stamp. And you don't have to worry about keeping it. It's a piece of paper, sits in your demat account. Interim liquidity possible. If you want your money, they are traded in the stock market. On top of it, the tax efficiency. They are fully exempt from capital gains tax. So you invest in gold, assuming you get lucky with the gold for your period of holding with the sovereign gold bonds. You realize the money, whatever be the gains, they are completely, you don't have to pay any taxes. So you got gold gains plus 2.5%, no tax.
Well, this sounds very lucrative.
But you can't have the fun of wearing it. So
Okay.
you can't have the joy of wearing it and show it off. So
All right.
it's far less fun. So
Okay, if you want to invest in gold, then as Dhiren just explained, sovereign gold bonds is something that you would recommend.
yeah,
Because
for the
there's-
gold fanatics. Yeah.
For the gold fanatics. Otherwise,
Also, there a lot of people have this mindset that they have their young daughter, she'll be married off, and one must have gold. So, and gold will be very expensive when
That time,
she's
yeah.
of the marriageable age.
yeah.
So why not do your SIP in gold? My counter argument to this is invest in an equity fund. Invest regularly the amount which you plan to invest. You'll be able to buy more gold when she is of the marriageable age, because I'm sure that any 10-15 year period, a good reasonable equity diversified option will actually deliver you more.
Okay. So you heard the options that Dhirendra has put before you. Exercise that and see. But if you still have to invest in gold, then
Of course, that's the best option. Sovereign gold bonds.
sovereign gold bond is something that Dhirendra is recommending to you. So we now move on to the Q&A part of this program, and our first question has come from Devanshi, who says, I want to invest some amount for my retirement, which is due after 10 years. Should I put the money in gold ETF or equity ETF?
You heard me in the context of
Yes.
buying, accumulating in gold. Not at all. Maybe an equity ETF, or yes, you have the equity ETF, the Nifty ETF, which is very cheap, 0.5% cost. But I would say that in India we still have a reasonable case for actively managed equity funds. Choose a multi-cap fund or an equity ETF, and definitely not gold ETF.
Okay. Akash says, how can Indian retail investors diversify their portfolio to mitigate country and currency risks?
You have interesting options. You have international funds available here. So the way it works is you buy exactly the way you buy a domestic mutual fund, but those funds invest abroad. There are 2-3 formats in which you can have it. One is a fund which is largely a domestic fund but invests a part of its money abroad. So it has been able to de-risk yourself a part of it, 15, 20, 25%. So Parag Parekh or Franklin Templeton's equity income fund, they invest a part of the money abroad. So that's the simplest way of, you also get all the tax treatment of an equity, of a domestic equity fund. Of course, that's not a great differential anymore after the clamping of the 10% capital gains on long-term capital gains on equity funds, but still. Then you have other options in terms of a fund which is sold in India, invests abroad completely. So you have US Equity Opportunity Fund and many other things. You have some such 20-30 options, so you can invest in them. Of course, any investor can invest abroad on his own by opening a brokerage account in any international broker. The process is very simple. Open an account, and a single account should be operating that, and you can invest up to $200,000 annually, which is quite a sizable investment for an allocation or entitled or facility to invest in a year. But that could be complex. You'll have to choose your investment, and you can buy any asset. You can buy a house, or a fund, real estate fund or any such thing which will be getting you income or anything. Yes, you are able to de-risk yourself from, we have our jobs here, we have our investments here, so why not diversify? So that case is very strong. That apart, I find that some of the US domiciled funds or the US targeted funds, they have proved to be very interesting, despite, one is that the kind of company that you get there, the kind of businesses you are able to invest. You don't innovation driven technology businesses, which are global businesses global in nature, the whole world is their market. We are used to Googles and Amazons and everything, but we don't have them as shareholders. You can have them directly. So, you can have that NASDAQ 100. There is a NASDAQ 100 fund which invests in that fund. So that makes it easier. You have the US opportunity fund. So, and I look at these US domiciled fund as they look like, they are investing in US companies. But the underlying nature of the business, that makes them international opportunity options.
So Akash,
very well diversified global businesses.
Yeah, so I'm certain that Akash has heard what Dhirendra said. There are many options actually to mitigate country and currency risks as elucidated by Dhirendra. Going on next, we have a question from Aman, and he says, I want to ride the wave of gilt funds by investing a lump sum and amount and planning to diversify by investing in money market and banking or PSU debt funds. Does the interest rate risk prevail in banking and PSU funds as well?
Yes, very much so. And gilt funds, try your hand, but most of the time when we are tempted to ride the wave is the time when you should not be tempted to. Because right now one will be looking at 20% return, 18% return on some of the gilt funds, right. And when you try to ride it, it actually goes downhill. Ideal time to ride this wave would have been before this return actually, before they gave this kind of return. And all debt funds, they are subject to of course, I don't visualize right now that this return has happened because of the rate cuts. I think I also visualize that there will be future rate cuts too, but not at the same pace at which we have seen in the recent past. So you will ride the wave, you will not get the massive blow, but you may not be able to ride the wave upward in the same way which is actually looking at the rear view. You are getting tempted to that this recent past performance will repeat. It may not.
So what you're saying is don't time
avoid.
You
just think in terms of, and with fixed income, don't do all this. My sense has been that in fixed income you don't get a bonanza. You have to look at fixed income in a manner that you don't lose your capital. It should be your conservative allocation. It should be your rebalancing allocation. It should provide stability to your portfolio. Do all your things with get all venture sum with equity. Buy the small cap fund. Buy something else. Use fixed income to provide stability. Use fixed income not to protect the downside, and manage your risk and work on your asset allocation. And that's the simplest thing which you can actually embed in your risk management framework. Every individual should have.
Okay. So what you're saying is fixed income for stability.
Yes,
simply put. Stability
and don't get attracted by this 25%. Not too many people have been able to get this. You just see it in the numbers.
Okay. While investing in ELSS, is it better to go in for SIP route or to invest lump sum? And this is from Gopinath. Also, while selecting the fund, should we just look at the past performance, or are there any other factors as well to look into?
You should look at past performance when looking at funds, but the way you look at past performance is different. You should look at long-term past performance, how it did in a falling market and how it did in a rising market. If you are looking at, in the previous question what I was saying, that somebody is looking at 1 year return of a gilt fund or a gold fund and is getting attracted, that is not the way to look at past performance, because that looking at that rear view of recent past, you tend to think that this will repeat. And you come with a lot of expectations, and normally when you are looking at such returns, it is unlikely to repeat. So you get disappointed and you get driven out of it forever. So the way to look at past performance is understand the dynamics of the return. how erratic it has been, how it has been derived, because you will find that in the last 5 years or in the last 7 years, one fund gave a 20% return, another fund also gave a 20% return. But in one fund, most of the return came in 2 years. In the other fund, it came very consistently. In one fund, it was largely by protecting the decline in a falling market. In the other one, it fell dramatically and then made all the money in those 2 years or 3 quarters or some such thing. I would say that based on the character of the return, how those returns are derived, that is reflection of the fund manager's choice of stock, the kind of stock he's choosing. You will also be able to figure out that whether it is an accident or whether it is a design. One by design are likely to be repeatable. One which is an accident, then you have to wait for the accident. So that's the way to look at past performance. Should you be investing in ELSS by way of SIP? SIP is basically, in ELSS you can do without it, but I would still suggest why you should do your SIP in ELSS. We earn every month, why not invest every month? But in ELSS, and the whole idea of doing a SIP is that when you make a lump sum investment, you get scared, odds are against you psychologically when you see a sharp decline. In ELSS you can't do anything about it, you get stuck for 3 years. So that risk isn't there. You can see, you can get anxious, you can get nervous, you can curse, but you can't do anything about it. And in 3 years time frame, you end up getting a meaningful return. So in ELSS if you are going to invest for next 20 years, 30 years, and even investing in the month of March, it is your SIP.
Once so that makes it lump sum.
Yeah, you can, that's another way of looking at it, that here is my regular investing where I'm making an annual investment for next 30 years.
Okay.
Instead of every month. But I would say that, what fits in with your income cycle, which is a monthly investment. We earn our salary every month, we spend it every month, we pay our home loan EMI every month. Why not SIP too? And you don't get, your accountant will not warn you or threaten you that he will cut the TDS if you haven't done that, because you can give all your investments that you have made, and that will save you the last minute worry.
Okay, Mukesh would like you to make him understand the net asset value. What is it all about? NAV.
When you invest in a stock, the price changes every day, and you know that if you have 100 shares of a stock which is priced at 100 and tomorrow it is 101, the price has gone up by 1%. In case of a mutual fund, it is a spread, it is a basket of stocks or a basket of bonds. So you sum total the value of all those bonds, days change, and that is what. So it is effectively, but there is more calculation to it. In an open-end fund, some investors come, some investors go. So that money has to be deducted and invested. Then the fund has to deduct its expense. The annual expense that it charges is charged on a pro rata basis every day from the fund, because a lot of new investors are coming in and going out. So value of investment minus expenses, and that on a per unit basis is the net asset value. The simple understanding, NAV is the price of a mutual fund.
Okay. And how important it is in calculating the gains?
That's the basis.
That is the basis.
You bought it at 100 rupee, today the NAV is 105 rupee, 5
rupee
is your gain. So that's the price for a mutual fund.
Okay.
Net of expenses.
Okay. Akshay Ranjan has written, what would be the ideal mix of different mutual fund categories for my portfolio in the current market situation? My aim is to beat inflation and create wealth.
The answer to this question is not dependent on the current market situation. It is for all times, for everybody. There are different ways there are different levels of complexity which you can follow depending on your number of years, your experience in the market. The simplest one is having embedded allocation, buying 1 or 2 balanced fund for somebody who is, nervous, never experienced the market. The next level is, buying 1 or 2 multi-caps, so you get exposure to all segments of the market without much of a worry. Making it a little more sophisticated, you want to have more aggressive, you have more aggressive expectations in terms of, higher returns. You want to allocate more to mid cap, small cap, or a certain strategy. You want to invest in an international fund to de-risk it. So, depending on that, you can then do it yourself, having a larger allocation to small cap. But I think most of these goals should be achieved. Most of these so these are different levels of sophistication. All of them will produce a return in line with the balanced fund or the multi-cap fund, or a portfolio which is a combination of mid-cap, small-cap, and an international fund. Higher allocation to mid and small cap will generate little higher return, but over a 10-15 year period. Otherwise, in a brief period of time, and there will be times when when some of the returns will be very disappointing relative to others. So I would say that depending on this, even the middle path is the finest one for most people for 8-10 years to carry. Buy 1 or 2 multi-cap fund. If you are a tax-saving investor, if you are also an investor in the tax-saving fund, consider that investment as your multi-cap fund investment, and that's the simplest way of carrying an all-equity portfolio.
Okay. Balaji Rangachari has written, is it wise to consider amount in EPF gratuity as part of debt allocation and continue my future investments more in equity mutual funds?
Yes, it is, because it is debt. And ideally, if you are making your investment in PPF or EPF or the gratuity entitlement, which is, gratuity is actually not an investment in that sense, because you don't get the investment value. It's an entitlement that for every year of service put, you'll get 15 days salary when you leave your job or when you retire. So it should be looked upon as your fixed income allocation when you are totaling up. The only problem is that you can't do the rebalancing. If you have chosen to have 50% into equity, 50% into debt, you really can't do much about unless you intervene. Your EPF, it turns out to be 80%. What do you do about it? Do you pull out money from EPF? Gratuity you can't take out till you leave your job. So they are inflexible. So, but within that framework, yes, they are fixed income investment, and it should be considered as one.
Okay. Mary says, is it possible for the value investment in a mutual fund scheme to drop to zero?
It hasn't happened so far.
But interesting to know.
Yeah, but nothing can be ruled out. We live in a very different world. But by this, what you mean, Mary, is that you give your money to a fund manager. He invests in a diversified portfolio of 10, 15, 20 stocks, which by design he has to, because SEBI regulations puts it as a mutual fund company cannot have more than 10% in a single stock or X% in a single bond. It must diversify. And the fund manager chooses those 10, 20, 50 stocks, and all of them disappear to the tune that they are worthless. They all become zero.
Highly unlikely.
Yes, but what you are asking is that how bad it can get. I'll try to, just try to.
That would be better, right?
How bad can it get? And it can get very nasty. It has happened in the past. A lot of people got excited in year 2002 about technology stocks, and fund companies did launch technology funds. And the first technology fund was that Kothari Pioneer technology fund, and it went up by 100% in the first year, went up by another 100% about 100% in the second year. And once it became so large, it went up, it galloped so dramatically that everybody was sucked into it. Then many fund companies launched their technology fund. And most of this technology fund, which raised the big money from those excited investors who have witnessed that past performance of doubling money every year for past couple of years or all thereabouts, their money got reduced by 70%. Their 100 rupee invested became 30 rupee. And then it took 7 years for them, for their 30 rupee to become again that back to 100. That happened to Infosys as well. Somebody who got excited to invest in Infosys in 2001 made no money for the next 7-8 years.
Oof.
So
it can happen.
It can get bad. But Turning to zero? No. Turning to zero generally happens that you gave your money, and most people have this impression that you entrusted your money to somebody. He took out all the money from the bank, put it in a gunny bag, and walked away. That cannot happen in mutual fund, because the whole design structure, custodian, the way it is structured. Of course, if somebody decides to go to jail and is so brazen, so I don't know, but it has never happened, and I visualize that there are risks in the market. But risk in the design, no, I don't fear that.
Okay, let's keep our optimism actually at high and continue to invest regularly. That's all we have in today's program. Dhiren, thank you so much for answering the queries of our listeners. Till we meet next time, it's goodbye from both of us.